Hey guys, happy Friday. So this week has kind of been a whole lot of nothing. We started off Monday with the market being closed. At the end of the week here, we're looking at pretty much being about where we finished last week. So we saw some pressure Tuesday. Wednesday, that carried in a little bit further when some of the Fed members were talking about inflation, and that didn't help us any. But we did get a break yesterday. GDP came out. It was about what was expected, so that was helpful yesterday. And today we got the PCE report for the month of April, and that came in right where it was expected. So with that, we saw rates actually start to improve a bit this morning. But before the afternoon is over, kind of like last week, they started tailing off. And at the end of the day here, we're not as good as we were earlier today. So again, mostly moving sideways right now, maybe even sideways to slightly worse as far as rates are concerned. And I think it's just going to take data to change that. You know, in real estate, it's all about location, location, location. However, right now with mortgage rates, it's all about data, data, data. That is what's driving rates right now. It's inflationary focused. The good news is this coming week, we have a ton of data. The other piece that's good news is that the Fed is in a quiet period, so they won't be speaking for the next 10, 12 days until the next Fed meeting occurs and the minutes are released. They'll be quiet. So that actually could help rates a little bit, especially if this data coming next week is favorable. Friday of next week, just like Friday of this week, has the ability to really move things and change things. Will it? We don't know yet. But next week on Friday, we've got the non-farm payroll, the jobs report. So it's a look back at how many jobs were created last month. We also have the average work week, hourly earnings, and the unemployment rate. So all very big movers that can really impact rates will be coming out on Friday. And then the following week, we got more data. So this is a time where we're keeping an eye on things, closing in the next 15 days. We're probably got our finger on that trigger, maybe locked already, because we're just seeing it move sideways and maybe even a little bit worse, although we're seeing some breaks from here and there. If we're 30 days or out, I think we can monitor things almost on a weekly basis, on a week-by-week basis, as long as the data continues to come in and doesn't really shake things up too poorly. And then if we're out there for 3 months, 6 months, you know, if it's new construction and we're waiting, we've got time. There's going to be a lot of data coming. I anticipate we're going to see things creep up a little bit as far as some of the inflationary numbers. And I think I talked about this a few weeks ago. There will be some reports that will be dropping off from last year, and they'll be replaced with reports that are going to be similar or higher just because of where we're at. And so that may skew things. But I think when we start looking at like September and October and November, the end of the year, I think we're going to be looking at a much more favorable picture as it relates to the inflationary factor of things, and we'll be good to go. So I hope this helps. Have a great weekend, and let me know if there's anything you need.